Well, hello, hey, it's Jamie here with Reese Homes, and it's tax season. And I wanted to talk to you today about how to read your settlement statement from the sale or purchase of your new home so that you can take advantage of the greatest number of tax exemptions and deductions possible. So, when we look at this redacted statement, we can first of all note that we've closed at the end of July of the year. And when we're looking at these statements, that wanted to point out that if you're the buyer, pay attention to the blue boxes. If you're a seller, pay attention to the red boxes. And the first and probably the most complicated way or complicated item to look at in the settlement statement is the distribution of the proration of property taxes. Now, it's important to know that property taxes are due and payable to the county in April and October. And when this transaction closed, which was at the end of July of this year, the seller had not quite paid the taxes for the year, right? They were going to wait until October to do that. Nonetheless, some tax accumulated there. So the seller ended up paying the buyer $455.54. What the buyer would then pass along to the county later on. So one of the things that the seller of this property is going to want to do is they're going to want to add the 455.54 to the amount of money that they paid in their first half taxes. Now, the amount of money that they paid in the first half taxes, they can find that information out either by looking back at their tax bill, looking at their mortgage statement if their mortgage company had paid their first half taxes on their behalf, or if they don't have either of those documents, give us a call and we're happy to look up the property and show you where you can find the information about the receipt for your first half taxes of that year. So that's what the seller would want to do in this particular case. Now, the buyer in this case would look and say, well, technically, if they wanted to absolutely count their property tax paid correctly, they would want to then deduct the 455.54 from the second half taxes that they actually paid in October, whether they did that themselves or their mortgage company had done that for them. And again, same rule applies there. They can look at their tax bill that they received. They can look at their mortgage statement that if the mortgage company paid it on their behalf, or if they need a source outside of those two things, contact us and we're very happy to help you find the source of those second half taxes that are paid. And here's just a little guide. So if you look here, that if you were trying to figure out, well, how does this apply to me? And maybe I didn't sell at the end of July. You want to keep in mind that if you close your transaction between January 1st and approximately April 15th, or July 1st and October 15th, typically the seller is paying to the buyer some sort of credit because they're paying for taxes that were assessed, but they hadn't quite paid yet. Now, on the opposite side of things, money flows the opposite direction if you close generally between about April 15th to June 30th or October 15th to December 31st, because that's the time frame where typically the seller would have already paid for that section of the taxes, that half of the year of the taxes, and now the buyer needs to reimburse the seller for prepaid taxes. So that's just a good rule of thumb in terms of helping evaluate your settlement statement with regard to the prorations and adjustments for your property taxes, which are tax deductible up to about $10,000 along with your sales and other local taxes for your federal income tax. If you've got any questions about this or you're confused about the debits, credits, all of that, just let us know, and we're very happy to help you help walk through that with you more specifically. Okay, so now the next line that we have here, these next two boxes are related to buyers. Now, your loan origination charge, and it's not necessarily going to always be loan origination. It can read a whole host of different descriptions, but typically your administrative fee, your loan origination fee, your underwriting fee, things of that nature are considered to be prepaid interest by the IRS in most cases, and they are tax deductible in the year of the origination of a purchase loan. Now, the origination of refinance loans, we're not going to deal with here. This is about a purchase. So those are considered to be tax deductible. So you should be able to add this to your tax deductible interest paid and be just fine. Now, keep in mind, you want to confirm all of this with your accountant or independently. We're trying to offer help in getting you started along this path and finding the right information for preparing your taxes. Likewise, your prepaid interest. Now, this line should be included, well, may not be included in the actual interest statement that you receive from your mortgage company, but you'll want to double check that and make sure that this interest that was paid at closing is included in your total interest paid to your mortgage company. So if I'm working, if I'm the buyer on this transaction, these are the two numbers with regard to origination and interest paid that I'd be very keen on making sure that it are included in my tax return. And then pretty much nothing else beyond that. So we're primarily dealing with property tax and interest paid on this particular one. Now, if we flip over and look at another of these settlement statements, we can see here this is a different different property, but this one also closed in August. So we're kind of dealing with that same flow of a debit for the seller and a credit to the buyer. And in this case, $570.66 flowed over to the buyer. So this is going to increase the amount of taxes paid for the seller, decrease the amount of property taxes paid by the buyer. In this case. Now, the other thing that the buyer wants to keep in mind here is that in this case, the buyer paid points to drive down the interest rate on their loan. So that's considered prepaid interest. So these two numbers, along with this number, would be allocated for their interest that they have paid towards the loan. So this is something that's a very significant amount of deductible money. So they're definitely going to want to look in on deducting those from their taxes. And then outside of that, as we scroll down here, the other thing that we want to look at for the seller is, in this case, the payoff for their mortgage included some substantial amounts of interest that were collected as part of the payoff. And so they would want to go back and confirm that this amount of interest was actually included in the final interest paid statement that they would get from their mortgage company, and or add this too. If it's not included in that interest paid, they're going to want to make sure to add this interest to that amount. And they'll need to go to their records and figure that out, but they'll definitely want to look at that because, again, it's a substantial amount of money that could save them a substantial amount on their taxes. So those are the things when I look through this statement that would be significant highlights to look at. Now, if you're confused by any of this information, please give us a call. We're very happy to tell you more about what we know. And if you're looking for an accountant or other tax professional to help just guide you through this process, confirm the information that we've provided, or just walk you through in a painless way to making sure that you're getting the greatest benefit of the tax deductions and exclusions that are available to you, we're happy to refer you to great professionals that we know locally. Thanks for watching, and we'll look forward to chatting with you soon.